I'm Dave Mecklenburg from TechShark Trading. Today we're going to talk about the two-period RSI strategy. But before we begin, I do want to remind you of the high degree of risk in trading. Been trading for more than one day. You know that you can and will lose money trading. Only trade with money you can afford to lose. I know we got a lot of new people coming in. Did a couple trades this week, so a lot of new people. Just very briefly, I got in this business working at trading markets. I guess it's about 16 years ago now. You might recognize a bunch of these names from CNBC, IDB, various trading books. There's Street Smarts written by my old boss, Larry Connors, with Linda Raschke. So I tell you this, is that number one, I learned to trade the same way as you. I read a bunch of books, flipped through a bunch of courses, because all the stuff was available to me there. So, and I actually, had to do it on my own time, just as you have to do it on your own time. Number two, no one has all the right answers. You can't copy one person's strategy. We all have something in particular about ourselves that prevents us from totally replicating someone else's strategy. Account size, risk tolerance, available time, level of skill. Again, I consider getting orders off without slips to be a skill that requires a lot of repetition. But normally, especially people new to trading, have a different risk tolerance than the type of people who write books or put on courses. So how much are you willing to lose on a trade? How much are you willing to lose over a series of trades? So you're going to have to make those adjustments. Take a strategy, adjust it that last 10, 15, 20% for your particular situation in needs, available time, available skill, and then start putting the reps. All right, so keep that in mind as we go through a strategy today. You're going to have to make some adjustments for your own particular situation. And then last, look, I've been talking to people for 16 years here. I've talked to thousands upon thousands of people at this point. I'm an expert on how people lose money trading. So again, use me as a resource. Ask me any question about trading. If I don't know the answer, I can point you in the right direction. So I want to remind you, context of this lesson, any lesson I do, any guest of mine, again, the Festival of Traders next week, 6 speakers over 4 hours. This is the context of all my lessons. Number one, trading's hard. I understand all the marketing is telling you it's easy. If you just do these simple things, you'll make a bunch of money. But bad news is trading is actually hard. But if you accept the fact that trading's hard, you're going to do a lot of things differently. You do a lot better job of protecting your account, protecting your principal, and you don't have to be like me or anyone else who started 15, 20 years ago, where you essentially had to lose 10, 15, maybe even $20,000 learning how to trade. Take advantage of the technology today, including simulators built into everything, live data. Paper trade it, simulate it. If you can make money doing those things, maybe you can make money using real money. But if you remember, trading's hard, you do a lot better job of protecting your account. Corollary to that is no one sells money printing machines. There's nothing you can purchase. There's nothing I'm going to tell you today that's magically going to print money for you tomorrow, where you're just going to spit out $500, $1,000. Doesn't exist. I'm going to give you a good idea. You have to investigate it further. Some presentations or lessons I give a full strategy. In this case, I have a back-tested strategy. It's from Stocks Commodities Magazine, but you're going to have to investigate it further. I'm going to give you some ideas or ways I would trade it or differences from the Stocks Commodities back test, but you're going to have to investigate it further. If you don't want to investigate it further, I guess it wasn't for you. If you don't want to investigate any strategy further, if you just want someone to hand you the answers, well, trading's probably not for you. So the only way you're going to learn this stuff is put in the reps. Look at some charts every day. Spend at least 10 minutes when you get home from work every day. Flip the charts, look at the strategy. Paper trade it. Do your paper trades over the weekend. Look back in time. Once you're comfortable with that, maybe you can use real data and then eventually use real money. But you're going to have to put in the reps. Right? The only way you get stronger, you got to put in the reps at the gym. The only way you get faster is you got to put in the reps on the road. And then hopefully the more time you spend with me, the easier it is for you to sniff out the complete nonsense, things you shouldn't be wasting time on. So we're going to look at the RSI indicator. Again, new traders, they love indicators. Think it's a recipe book for printing money. Not the case, but let's look at this indicator and let's see what we can do with it. And we'll look at a back test that was published and maybe ways you can use it. All right, so the initial indicator, the settings, if you go into your setting on any broker package, including settings on free charting, Google, Yahoo, the length is 14 on RSI. Overbought is 70. It's a 100-point scale. Overbought 70. That uptrend's likely to end. Oversold 30. Downtrend likely to end. And then the exits were slightly less than the opposite condition. So hey, look, if you bought at 30, it was oversold, you would exit somewhere around 65. If you shorted at 70, you'd exit somewhere around 35. So here's a article that was published with a back test written by my old boss, Larry Connors. Does RSI give you an edge? And they use the 2-period RSI. So they use slightly different settings. Instead of 14 period, they did 2 period. So the length is 2. Overbought to 98. Instead of 70, change that to 98. And oversold instead of 30, we're going to change that to 2. So in the back test was entry at the market close. So hey, run your scan, whatever popped less than a 2 or greater than 98, enter at the market close. Obviously, if you're back testing, that's a very easy number. Then is, hey, what was the closing price that day? So it's easy to back test that. Of course, you use the market close. And then exit 5 trading days later, 1 week. So Larry Connors, when I knew him, very big on multiple day holdings. And that's, again, a very easy test to do then is how many days? Okay, well, what's the closing price 1 day later? What's the closing price 2 days later? What's the closing price 3 days later? So turns out 5 days was kind of your best bet. And hey, that makes sense. Anyone who's been hanging around here knows that, look, big winners are a function of time. The longer you hold it, the bigger the possibility of a big winner. So 5-day holding period. And then just look, it just beat, it certainly, the short answer is it beat randomly holding stocks. Okay, this was published in November 2007, Stocks and Commodities. I can show you where that is. If you guys have subscriptions to Stocks and Commodities magazine, you can, with your subscription, you have access to the full archive. I can show you where that is. But they did this on 8 million trades over a 12-year period. All right, then they were able to improve the results using a trend filter. You know, only went long, you're above the 200-day moving average, only went short when you're below the 200-day moving average. So if you're going to run this scan, this is the typical scan I used to run and put on the website. I can show you where that is. Slightly different scan right now, but this was the initial scan. And if you want to change some stuff, you can. So I'm just going to read this to you so you can do your own scan. Most of you probably don't have MetaStock. So if I read this to you, you can build your scan and whatever else you're using. I'm also going to show you the TradeStation scan. So MetaStock RSI close, C is close. You can either spell it out or do C close 2. So 2-period close, less than 2. This is, I like to do a universe of liquid stocks. So generally I consider liquid stocks, tighter spreads to be between 20 and 120 bucks. And you can change that. If you think, you know, something better, obviously stocks are at all-time highs. Sometimes you got to push that out, but generally I do 20 to 120. And then the 10-day moving average, moving volume 10 simple. That's the 10-day average on the volume above 500,000 shares. That's all that says. All right. Again, using that trend filter here. Again, the closing price is above moving close 200 simple, meaning the price is above the 200-day moving average. That's all that says, right? And then if you were going to do the opposite, the short, so then our RSI close 2 is above 98, same universe of stocks, between 20 and 120 bucks, at least 500,000 shares. your 10-day average. And then today's close is less than the 200 period moving average. That's all that says. All right, so that'd be a very simple scan in almost anything. You guys can do that in TradeStation. So in Metastock, you can do this in one scan, right? Each column is the scan. In TradeStation, you need to have separate scans, long and short. But you know, you'd see, look, we got the same thing going on here. If we were to press this plus sign, we would have be able to type in 2 instead of the default 14. So the 2-period RSI less than 2, same universe of stocks between 20 and 120 bucks, over 500,000 shares, and then the close, today's close is above, and then it would give us a choice, and we'd have 200 typed in there above the 200 period moving average. Exact same scan. All right, and then, you know, obviously do the opposite for a short, above 98, and then below the 200 period moving average. Simple enough. You can replicate that in anything you do. So let's go over quickly the problems with this strategy, or what I would say normally the problems with this strategy. So first off, you're in the business of catching tops and bottoms. You're getting what, a big massive sell-off in the market. All these stocks pop as oversold, and now you're catching a falling knife at the close, right? Buy at the close, hold 5 days. Or hey, the market's running up, you got a bunch of overbought stocks, so that you're going to short. So are you catching a falling knife? Generally, that's a loser's strategy. And of course, you're going to have some bigger losers. So it puts you in a position having losers bigger than winners. And again, generally not a good idea. Some strategies where that's okay. Obviously, some option selling strategies, that's going to be expected. But if you're doing a symmetrical trading strategy, same rules, only opposite long and short, generally not a good idea. You're not controlling your risk. Obviously, there was no stop on that, right? You bought at the close, held for 5 days. There's 8 million signals over 12 years, so 600, 700,000 signals or trades, which obviously you can't trade all of them. Now, again, the exits weren't based on any technicals. It was purely time. They did update the strategy later, where I guess they had better results, where you did something similar to the initial strategy of exiting at 65 on the long side or 35 on the short side. And of course, obviously, is a lagging indicator. I'm going to address this lagging indicator bit on the next screen here. So those are general problems with the strategy. I think you guys get this. Any questions on possible problems with the strategy like this? So here's where I talk about keys to a trading strategy. I always go over this when we talk about a strategy. I got 8 points here. I like to address these points. Anytime I'm building a strategy or thinking about a strategy or analyzing a strategy, I like to address these 8 points. So if you're building a strategy, think about this stuff. Number 1, control your risk. Think about the downside before you think about the upside. Got to address that. Obviously, a stop is the most obvious way to do that, but there's other ways of controlling your risk. We have one way of doing that too. A little bit later, when we look at the strategy. Control our costs. Again, commissions, the most obvious thing here, but I consider wide spreads and slips to be a cost. You know, needing to trade liquid stocks is obviously a simple solution there, where you can get good fills. And obviously, the more you're trading, the more signals you have, the more things you trade, you know, the more cost you may have. Simple is always better than complex. Higher the complexity, the higher the likelihood of errors. But simple seems to stand the test of time. It gets outside the noise. It gets outside the big money. And I said simple, not easy. It's still hard. Trading's hard, but simple strategies seem to work better. Range, volatility, whatever trading needs to move. So again, trading penny stocks or tiny stocks or things that don't move, there's no money in that. Again, if we do our universe of liquid stocks, typically S&P 500 stocks, Those move every day. Again, the trend is your friend. In this case, we do have a trend filter of being above or below the 200-day moving average. That's the trend. That's the overall trend. Even better than the trend, though, we also want to be on the side of momentum. So again, that's the problem of catching tops and bottoms is you're going against momentum. You actually want that price going in the direction of the trade when you take the trade. Right? We're kind of going opposite. Right? We're going long while something's falling. So, you know, momentum is a good idea, and we're going to address that when we look at ways to trade this. Make sure that we have momentum on our side. Confluence of leading indicators. So again, all indicators are essentially lagging if they're a derivative of price, right? And obviously RSI derivative of price here, it's a lagging indicator. So what do I mean by leading indicator? So when we take a trade, we want to know what the entry and exit is when we take the trade. So something that helps us know those price levels when we take the trade. So what I'm really looking for is, if I want to know the entry and exit when I take the trade, is whatever indicator I'm using needs to be on the price chart, right? RSI prints below the price charts. Again, when we pull up the charts, you'll see definitely prints below the price charts. So if we're looking at RSI, we're not looking at price. So we want to look at price. What are some things that print across the price charts, gives us some lines, some indicators on the price charts that will give us an entry and an exit, visibly give us those things as we take the trade. So again, some obvious leading indicators, things that print across the price charts. We've got the major moving averages, the 20, the 50, the 200, all the big money uses it. Look, it doesn't change intraday, changes just a little bit at the end of the day. Elliott wave, Fibonacci, retracements, extensions, trend lines, even better, recent highs and lows, today's high, today's low, yesterday's high, yesterday's low, the swing high, the swing low. So those are leading indicators, and confluences, look, two or more of those just line up. Again, it'll be a little more obvious when we throw up the charts here, but that's what we're generally looking for. And then, hey, the last point is I always like to see, again, especially if we have a symmetrical trading pattern, same rules, only opposite, long and short. I'm looking for my winners to be bigger than my losers, right? Our targets have to be bigger than our stops because our winners need to be bigger than our losers. As an individual trader, your edge is going to be small. You're going to be right approximately 50% of the time. So how do you make money? It's because your winners are bigger than your losers. Again, easier said than done. Again, most of us are not comfortable being right 50% of the time. We're wired to want to be right, right? We like being right 100% of the time. And we're wired to try to find a strategy that's right 80, 90% of the time. Doesn't exist, just so you know. You can give up right now. You're not going to find it. I know you want to find it. You're not going to find it. So again, being able to accept that you're going to be right about 50% of the time. Easier said than done. But we're also wired to let our losers run, because it comes back to break even. It's not a loser. But the problem is losers become even bigger losers. And we're wired to lock in those wins early. Because if it comes back to break even, you give away those gains. Oh, so let's lock it in. But the problem is winners become even bigger winners. So this is where the reps come in. This is where you got to do the reps, and you need the screen time, and just convince yourself, watch constantly, and seeing how stocks make big moves and they do trend, or there is momentum, and that a winner becomes an even bigger winner, and that a loser becomes an even bigger loser if you hold the position. So we got to train ourselves to cut our losers once we're outside of normal volatility, train ourselves to ride wins to even bigger wins. All right, so they've been telling you 3 ways how to trade RSI. And we're going to look at some examples, charts, things like that. I'm going to throw up the stocks, the RSI scan for tomorrow, show you where that is, just on it's free on the website. I don't have anything to sell you here, just so you know too. So it's all free here. So one way to trade this is, look, do a basket long and short, right? I talked about, you know, the problem is when the market sells off. So we got a big market sell off. Look, you could have 100 stocks that pop below 2, oversold, right? The market's going to move sectors and stocks. So the problem is that when we have these big moves, you're only going to have stocks on one side of the market. All right, so what? You took 10 positions, 10 oversold stocks, what happens? Oh, the next day, market's still alive even more. You're stuck with 10 losing positions, right? So you can protect yourself without a stop here is if you had a basket long and short, that you always match longs and shorts. And if you want to take 4 positions or 6 positions, right, you have 2 long and short, 2 or 3 long and short. So, hey, something weird happens overnight. Maybe it's the day you buy the stock, or maybe it's, hey, 4 days in. But if you have a basket long or short, something weird happens, you're protected with half your positions. So that's a simple solution. Here's what people like about indicators. I'm going to show you how to trade divergence here. This is one way to do it. There's various ways to do divergence. This is how I would do it. So this is divergence. So here's your signal. RSI2 popped on this one, right? We're below 2 there. We popped the signal. What I'm going to do is I'm going to ignore. I'm just going to ignore the signal and wait for a better price than we got here, but no signal. That's my divergence. Better price, no signal. Lower low without a signal. And so we actually get a lower low here. But I'm also going to trade this, by the way. I'm not just going to just randomly jump in. So we got a lower low, no signal here. But what I want to do is I want to trade it by being on the side of momentum, right? So I want to break the high of this bar the next day. I want to break the high that new lower low. Right now I'm going in the direction of the trade. So if I break the high, I'll enter the trade. It's kind of a confirmation bar, right? But also we're going to be on the side of momentum. But hey, next day we got an even lower low. Hey, great, better price. Do we get a signal? No, no signal. Perfect, got a better price. Now if I break the high of this bar, I'm in the trade. So no trigger the next day, but 2 days later, depending how you want to trade this, maybe you want a signal the next day. Maybe you don't care. But if we break the high of this bar, now we're going in the direction of the trade. So that's one way of doing, again, divergence is ignore the signal, wait for a better price with no signal. Right? All right, so I got our signal, we're going to ignore it. Wait for a better price. All right, better price, break the high to trigger the trade the next day. Doesn't do it, gives us a better price. Great. No signal. Break the high, breaks the high the next day, triggers us in a trade. Again, one way to do divergence on something like this. So the third way, and would be my preferred way, is just trade it like a pullback. Right? So I usually teach pullbacks maybe once a month or every other month. I'm going to review pullbacks, but look, we have a trending stock and we're just going to trade it like a pullback. Right? So we get the signal here. So if we break the high of that last pullback bar, that triggers the trade. Next day pops up into a trade. Right? So we're always going to use the high of that last pullback to trigger a trade, or the low for shorting to trigger a trade. So that's pullback. So let's just review pullbacks. Again, obviously trending stock is just obviously trending, right? Recent high, pull back off that recent high, break the high, that last pullback bar to trigger the trade the next day. If it doesn't, hey, if it doesn't break the high, no trade. If it gives us another a lower low, great, got a better price. Now that's the last pullback bar. And then we want to use a stop here. So here's our where's a good stop? Obviously on the back side of this. This might be a little tight. Here's your kind of pullback low here. That's probably a little tight. So maybe this pullback low puts us on the other side of the 50. That gives you a stop. And then we want to hold these trades a lot longer than 5 days. All right, if we're in a trend, we want to stick with that trend. Once we got enough room to move to break even, stay above the 50 here. Once we got a lot of room, stay above the 200, we can stay in trade for a couple months. All right, that makes sense how to trade a pullback. Again, more examples here, right? Obviously trending, 3-day pullback, break the high of that last pullback bar, trigger a trade. Stop on the back side. Again, this little pullback low here, a little tight, probably want to be on the back side of 50, give it a little room. Again, if we're holding overnight, we need bigger stops. This is a short answer. Can't have a really tight stop if you're going to hold overnight. And hey, if the stop's too big for what type of target you expect, well, then throw it away. No trade. Stop's too big. Or you can't take a trade that has an $8 stop. Not going to happen. All right, no trade. All right, obviously trending stock, pullback, lower lows, lower closes, lower highs, right? Next day, it breaks the high, that last pullback bar, triggers a trade. Good place for a stop on something like this is consolidation on the backside of the 50. Pretty good spot. Again, try to stay in that trend as long as you can. Turn a winner into an even bigger winner. Again, pull back here. Look, you're going to get some inside days. You're not going to have necessarily perfect pullbacks, but certainly this last pullback bar needs to be a down bar, right? Break the high. Stop on the backside of this swing, 50. Ride the trend. Here's an example where I always show this one. Just look, you don't need a 52-week high. I usually run scans of 100 days because you get things like this, something rolled over and then rolling back over. Right, we're still, our 200 is still above the 50 here, but this is obviously trending. Right, here's our last pullback bar here. This red bar, trigger a trade. This already would have triggered. Maybe the stop on the backside of 200. Short, downside, same rules, only opposite. Obviously downtrending stock. This is your last pullback bar. If it breaks the low of this bar, trigger a trade. Right, stop on the backside of the swing high probably. In the case of targets on shorts, though, is we probably want to get inside some lows, 52-week lows. And if we don't have anything or it's not far enough, no trade. Generally, I show these examples, especially alongside, is everyone can take advantage of this. I'm going to show you, just what happens in the market or when's a good time to do this or why this is applicable to everybody, especially with retirement accounts. But so again, downside is the last example of a short here. Here's your obviously trending downward stock. Here's your last pullback high, triggers the trade, triggers you into a trade here, right? Very simple here. So if we use this RSI, trade it like a pullback, then we can do those things, right? Obviously trending stock, here's your pullback low with a signal. If we break the high, triggers a trade. Stop on maybe in this one case, back of the 200. So again, we're not going to get these perfect pullbacks like we did in my pullback examples, right? This is actually a pullback that would have, popped on my pullback scan right here, a recent high 3-day pullback. But in this case, we didn't get a signal till here. But we can still trade it like a pullback. If we break the high of this bar, it'll trigger a trade. Stop perhaps on the backside of the 50. Again, this is when I talk about confluence too, right? The low confluence with the 50, that's the confluence of leading indicators. Right, if we break the high of this bar, maybe stop on the backside of this swing low right here. Short side, same rules, only opposite. Again, break the low of this last pullback bar. Right, stop maybe on the backside of the 200. Again, same thing. Got a signal here. Oops, sorry. Break the low of this last pullback bar to trigger a trade. Stop perhaps on the back of the 200. Again, got our signal here. Break the low of that last pullback bar to trigger a trade. Stop perhaps on the backside of the 200. Same thing again. So similar setups. Right, and then, okay, I got this one in here because we got our signal here. Last pullback bar, but the next day didn't break the high. No trade. All right, break the high of that last pullback bar. When you get a signal, that's going to trigger your trade. All right, and here's one where we got our signals here, but never broke. And now maybe it's gone on too long, or now we're above the 50. Maybe we don't want this trade, but it never broke the low here, never triggered a trade. Signal's been going on for a few days here, never broke the low, no trade. And same here too. So again, got a signal, didn't break the low, gave us a higher high. Hey, maybe a better price, but hey, maybe we're on the wrong side of the 50 here. Maybe we don't want the trade. But didn't trigger yet. All right, so that's kind of to the point. 30 minutes, how to trade something like this. Let me show you where you can get all this stuff. So again, Stocks Commodities Magazine, traders.com. If you got an account, you got full access. Here's your article here. Does RSI give you an edge? With that back test in it. I post the free stuff on the website. I call it RSI2 Pullbacks. So these are our stocks for the next day. So these are our stocks. So you can see that we have a signal on all of this, right? Stocks pulling back. And you can trade like a pullback. Only one on the long side. Obviously, the market's been trending here, so sometimes it's harder to find stocks on the opposite here, but here is one. And when I was talking about finding a target of getting inside some lows here, so you can see you got some lows here, and then maybe that's not a big enough target. All right, if you break the low, this last pullback bar, trying to get in some side, some 52-week lows. But on the long side, look, I just want to stay in the trend as long as I can. So for doing long side, what I really want to is I want to throw up spiders here as my last point on this. Is that when we have these market sell-offs that we're going to have, this is the spiders, S&P 500. When we have these sell-offs, you can even see we got signals on the S&P 500, but when we have these sell-offs, we're going to get these sell-offs in our stocks, right? And so this is the time really to look for these signals. Right now we're at all-time highs, the market's been moving, so maybe not a good time to get into this, right? Wait for another sell-off where we're getting a cheaper price. The market sold off, we're going to get a bunch of signals. Now that you're in a trending market, there's nothing wrong with the stock either, too. Hey, if the market sold off, all the stocks sold off. There's nothing particularly wrong with your stock, right? If it's just sold off because of the market, like that's a good time to look for these. And so, hey, maybe you take a couple positions a year just based on market sell-offs. Hey, the market sold off, let me find my stocks. And also, hey, if the market keeps selling off, oh, we got some signals here. Oh, the market sold off more. Oh, your stock keeps selling off more. Well, it didn't break the high. Didn't break the high of your last pullback bar. You're not getting trapped in these stocks then. All right, does that make sense? Is that simple, something simple that everyone can do here? Use that RSI2 strategy, particularly, maybe retirement accounts, but look, when the market sells off, start looking for these signals. And if we trade it like a pullback and break the high at that last pullback bar, that's going to keep us out of catching falling market or falling knife. All right, that's all I have on this lesson. I like to do everything and typically do our lessons here within 30 minutes or so, get to the point, and there'll be a recording. You guys get the recording at the bottom of the next hour. You know where to find this stuff, Stocks Commodities. This is where our stocks are, RSI on pullbacks. RSI2 pullbacks, excuse me. Any questions on this strategy or anything all to do with trading? I'll stick around and answer all your questions. Also, I'm going to stop the recording here.